This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 1, 2026, and this is the New York pre-market. Now, let's get into it. We are looking at a market defined by extreme bifurcation right now. The S&P 500 is hovering at $746.77, but that average tells a lie. On one side, you have the Technology Select Sector SPDR fund climbing nearly 3%, while on the other, real estate is cratering and consumer staples are getting crushed. It is a battle between megacap AI narratives and a broad exodus from defensive assets. Let's see where the pressure points are forming as we head to the open. It feels like a pressure cooker waiting for a release valve. The VIX is sitting at 17.65, which is practically asleep. But look at the spread. Technology is up 2.76%, and real estate is down almost 2%. That is a 4.3% divergence between the best and worst performing sectors. Options traders aren't hedging for a crash, they're pricing instability, but the internal mechanics suggest otherwise. We have capital fleeing safety nets, like staples and utilities, to chase yield in high beta tech. That's not confidence, that's forced exposure.
Let's look at the map. The SPY is at $746.77. It is sitting 23 cents below its 5-day high of $748.02. That is a razor-thin corridor. If this breaks, we aren't talking about a slow grind, we are talking about a liquidity grab. Meanwhile, the triple Q is at $736.40, facing a ceiling at $737.62. The Nasdaq has less room to run than the broader S&P. And look at the Russell 2000. IWM is at $300.45, testing its 5-day high of $300.98. It's barely hanging on. The technical structure is showing that the bulls are pushing against a wall, and the wall is named $748.02.
And that wall is built on sand. You're both focused on the breakout level, but ignore the foundation. The 10-year Treasury yield is effectively flattening against the 2-year at plus 30 basis points. A flat curve usually precedes a slowdown, yet the market is acting like we're in a Goldilocks zone. The VIX at 17.65 is misleading. It suppresses the cost of insurance just long enough for everyone to forget that the underlying asset classes outside of megacap tech are rotting. Consumer staples is down 1.54%. The utilities sector is down 1.48%. When the boring stuff gets dumped this hard, it's not rotation, it's capitulation.
So we have a contradiction. Grid sees a technical breakout opportunity at $748.02, but SPECTER and Pulse are flagging that the volatility suppression is artificial. The key isn't just whether SPY clears the high, it's how it gets there. If it breaks $748.02 without the IWM participating, which is currently lagging at just 0.5% gain versus SPY's 0.78%, then we aren't seeing a broadening rally. We are seeing a narrow squeeze. The leverage is concentrated in 10 names, and if those 10 stumble, the whole index collapses.
Let's zoom in on that concentration. The headline move is the Technology Select Sector SPDR fund, the technology sector, up 2.76% to $190.52. But dig deeper into that ETF, and you'll find a fracture in the supply chain. Let's talk about the semiconductor industry. Names like Micron and Lam Research are gapping down 5 to 6%. How can the sector ETF be green while the bellwethers are bleeding?
Because the technology sector is being carried by software and AI infrastructure, not hardware manufacturing. You have NVDA, MSFT, and Google pulling weight on bullish sentiment. Google is up 0.4%, MSFT up 0.27%. But when you look at the actual silicon and equipment makers, it's ugly. MU is down 5.4%, LRCX is down 5.2%, and SMTC is down 6.7%. The index is lying to you. The money is flowing into the narrative of AI efficiency, not the physical reality of chip production. It's a decoupling of software valuation from hardware fundamentals.
And that decoupling is the risk. When you strip away the hardware weakness, the remaining giants are trading at multiples that assume perfect execution. Look at the negative sentiment on NFLX and MSTR. MSTR is down 0.8%. That's a leverage play on Bitcoin and tech sentiment. When the hardware guys like Micron are getting hit with analyst calls involving NVIDIA, SpaceX, and Apple simultaneously, it signals that even the insiders are trimming exposure. You're buying the dream, but the engineers are counting the screws.
From a pure price action standpoint, the MU and LRCX gap downs create vacuum zones. They've taken significant support out of the board. For the broader the technology sector rally to hold, those names need to stabilize. If they don't, they become anchors dragging the sector down. Right now, the technology sector chart looks strong because the megacaps are offsetting the drag from the semis. But technically, it's a false strength. The relative strength is illusory because the component parts are failing individually.
Exactly, and check the materials sector. The materials sector is only up 0.34%, largely propped up by FMC jumping 6.1% on a $400 million investment from Tessenderlo Group. That's one company carrying the sector. Compare that to the energy sector, energy, which is down 0.88%. The breadth is non-existent. It's not a market rally, it's a stock-picking contest among the largest entities. If you're diversified across the S&P 500, you're likely losing money today unless you're specifically long Microsoft or Alphabet.
That brings us to the small cap end of the spectrum. The Russell 2000, IWM, is at $300.45. It's up only 0.5%. Compare that to the Triple Q, up 1.7%. The gap is widening. What does the chart tell us about the integrity of that $300 level?
The $300 psychological level is the line in the sand. IWM is currently at $300.45, clinging to the 5-day high of $300.98. If price closes below $300, it invalidates the minor uptrend that started earlier this month. It confirms the rich get richer dynamic we're seeing. Large caps are absorbing all the liquidity. Small caps are being left behind. Technically, a break below $300 opens up the 10-day low range, potentially heading toward $297.44. It's a breakdown pattern waiting to happen if the big caps falter.
The sentiment data supports that breakdown. Retail flow is chasing the Triple Q momentum, ignoring the IWM completely. You see the put/call ratios in the small caps spiking because institutions are using rallies to distribute shares. There is no conviction here. Everyone is selling the small caps to buy the mega caps. It's a zero-sum game within the equity universe and the house. The mega caps is winning. Until retail starts buying IWM again, the downward pressure on small caps is structural, not cyclical.
And remember, this concentration makes the market fragile. If the Fed speaks tomorrow and hints at rates staying higher for longer, or if inflation data comes hot, the small caps die first. They have less cash, less access to credit. The fact that IWM is barely green while SPY is up nearly 0.8% is a warning sign. It's the canary in the coal mine. The broader economy is not participating in this rally. If the labor data softens, these small companies are the ones laying off workers first.
Let's pivot to the defensive sectors, specifically consumer staples. It's down 1.54% today. We have GIS reporting earnings later today with an earnings per share estimate of $0.82. Why are staples being punished?
Because investors believe they can't pass through inflation costs anymore. We've seen CPI at 4.17% and core PCE at 3.41%. Companies like General Mills have been raising prices, but consumers are hitting a wall. If GIS misses on margins or guidance, it validates the thesis that the consumer is broken. The market is selling the belief that staple companies have permanent pricing power. If that belief shatters, the rotation out of consumer staples accelerates. Money leaves the defensive bunker because the bunker is leaking.
It's a loss of faith in the entire defensive complex. Consumer staples is down, the utilities sector is down 1.48%, the real estate sector is down 1.98%, three major defensive sectors in the red. This is a classic flight to risk, but it's a risky flight because the risk asset, tech, is relying on narrow leadership. If tech corrects, there's nowhere to hide. You're exposed nakedly to the market beta. That's why the VIX is low. It's not because people feel safe, it's because they think there's no alternative. But alternatives exist, they're just cheaper.
What about the megacap tech leaders? Meta Platforms is gapping up 6.3%. What's driving that specific move?
There's a headline mismatch in the flow data, something about Micron's run, but the price action is undeniably strong. Meta is reacting to improved ad tech monetization and AI-driven targeting efficiencies. Unlike the hardware names struggling with supply chains, Meta is a software/platform play. It benefits directly from the AI narrative without the capex burden of building chips. The plus 6.3% gap up reflects a vote of confidence in their ability to convert AI investments into revenue. It's the outlier success story in a sea of semiconductor hesitation.
Be careful with the outliers. When one name goes up 6% in a vacuum, it often attracts profit-taking from the rest of the sector. Traders might rotate out of weaker tech names into Meta, further draining liquidity from the broader index. It concentrates risk. If Meta turns, it drags the triple Q down with it, and since it's such a large component, the damage is disproportionate.
Technically, Meta is approaching resistance. If it continues to surge on volume, it helps triple Q break that $737.62 level. But if it stalls, it becomes a liability. The key is volume. Is this gap fill accompanied by institutional accumulation, or is it a short covering pop? Without deep order book data, we have to assume it's reactive. If triple Q fails to hold $736.40, Meta will likely fill the gap and reverse.
Let's look at the broader index context. The Dow Jones Industrial Average, Diamonds, is lagging significantly at $522.39, up only 0.14%. Industrial stocks are weak. What does this divergence between the tech-heavy Nasdaq and the industrial-heavy Dow tell us?
It tells us this is not a cyclical recovery. If the economy were truly healing, industrials and financials would be leading. The financial sector is down 0.2%, the industrial sector is only up 1.35%. The Dow is stuck in the mud. This is a liquidity-driven rally confined to balance sheets with massive cash reserves, big tech. Traditional economic indicators like industrial output are flatlining. The market is betting on productivity gains from AI, not consumer spending or industrial production. It's a bet on the future, ignoring the present.
The sentiment around industrials is grim. You're seeing put writings spike in the industrial sector ETF. Traders are betting against industrial rebounds. They see the flat yield curve and know that construction and manufacturing orders are slowing. The fact that Diamonds is barely moving, while triple Q rips higher, shows a complete disconnect between stock market wealth and factory floor reality. It's a decoupling event.
And that decoupling is dangerous. When the stock market rallies while the real economy stagnates, the correction is violent. The Dow's weakness is the truth teller. It doesn't care about AI narratives. It cares about orders and jobs. If the Dow breaks below key support, it sends a message that the AI boom is isolated and not sustainable. Historically, when the Dow lags this severely behind the Nasdaq, the eventual mean reversion crushes the high-flying tech names.
We also see energy under pressure. The energy sector is down 0.88%. Oil prices are stagnant, and energy names are getting sidelined. Does this energy weakness impact the broader market outlook?
Only insofar as it removes a hedge. Investors often hold energy as a hedge against inflation. With oil flat and the energy sector down, that hedge is gone. It forces capital into either bonds or tech. Since bonds are yielding little and tech is offering growth, the flow is inevitable, but it highlights that energy is exhausted. Unless geopolitical tensions flare up immediately, there's no catalyst to push energy higher. It's a dead sector in the short term.
So the map is clear. Tech is the only game in town, but it's fractured. Software is booming, hardware is crumbling. Small caps are dying, defenses are abandoned. Industrials are sleeping. The SPY at $746.77 is standing on the edge of a cliff at $748.02. If it steps forward, it's a trap because the breadth isn't there. If it steps back, it's a free fall because there's no support beneath the megacaps except themselves.
Let's wrap up with the key levels we need to watch at the open. Grid, you mentioned the $748.02 level for SPY. What happens in the first hour?
Watch the first 30 minutes. If SPY trades above $748.02 on expanding volume, the shorts get squeezed, and we see a quick run to $755.44, the 10-day high. But if it touches $748.02 and rejects, closing back below $746, it's a bearish engulfing pattern. Expect a rapid slide towards $745. The margin for error is 0.
And watch the VIX. If it ticks above 18.5 during that initial volatility, the complacent regime is over. Algorithms will trigger hedges automatically. You'll see a cascade of stop losses hit in the small caps first. Keep an eye on IWM breaking $300. That's your early warning siren.
Don't trust the headline numbers. If the technology sector is green but MU and LRCX are red, the rally is fake. Short the strength. Fade the gap-ups in Meta if they stall. The risk/reward is skewed to the downside because the fundamental pillars are hollow. Bet on the fragmentation, not the unity.
So, our summary for the pre-market. The S&P 500 is testing a critical resistance level at $748.02, but the breadth is terrible. Technology is leading, but the semiconductor supply chain is cracking. Defensive sectors are being liquidated, and small caps are lagging badly. The VIX is low, suggesting complacency, but the internal stresses are mounting. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.